So basically, we talk about the financial statement. It's going to have like the income statement, balance sheet, and statement of cash flow. So those are the three. You know, that's the three major financial statement we talk about. So the financial statement, where you can get is so say you go Google and you can see the we call it a 10K form. Okay, it's a 10K form, so you can see this is the major financial statement. We call it as a form 10K. Okay, the form 10K is in the United States is required by Securities and Exchange Commission. Typically, we call this one SEC. So SEC require all the public company to report, okay, their financial statement. So every company, public listed, and have to report their financial statement, okay, in a form called 10K form. Okay, the 10K form also we have is other one is 10Q. In the 10Q form, required by SEC, but this one is a quarterly. Okay, it's a quarterly financial statement, and the form 10Q is a quarterly financial statement, and the 10K form is an annual financial statement. Okay, so all the company, the data financial statement is available in SEC website. Okay, the system is called ADGAR, so ADGRA. Okay, so as ADGAR is database system. In the system, you can, for example, you go like a SEC ADGAR website, and you can search for any company's financial statement. So for example, we just search it Walmart, WMT, that's faster search. Because every company they listed, there is a ticker, okay, the symbol. You can search for Walmart. So you can see, click on that, the Walmart company, they have all the documents. That's the 10K form, right? Okay. And so the 10K form usually in March, so they have the documents, the 10K form. Okay. The 10K form, they have different section. So you can see all those different sections, they check that, and including the financial statement. Okay. That's we see all the where you can get this financial data, right? So when you click on that forms, you will have the financial data, right? Financial data. Okay. That's what we do. Okay. And first, we talk about today. We're gonna do is like a income statement, and then you have a balance sheet. Okay, so the income statement. Okay, so income statement is a record of the company's revenue and expenses over a period of time. Over that particular period of time is you see the income statement. The first one is the sales, the company's revenue or total sales. Right, we go here and you can see the income statement. Yeah, is total revenue. The total revenue is sales. Okay, sales. Okay, it's the same thing. And then the company, they exclude the cost of goods sold. The COGS is called cost of goods sold. Okay. so we have a, let's say, file with enable editing. Okay, so in order for you to know what is that, so we can have a cost of goods. So, okay, cost of goods sold. So what is a cost of goods sold? The cost of goods sold is the company's direct cost. Okay, the direct cost including materials, okay, materials cost, and the labor cost. Okay, the company make products and they purchase materials and also the labor cost. Okay, we call this one cost of goods sold, direct cost. And they have other expenses. Okay, those other expenses is indirect cost. You make a product, and you maybe put advertising, and also the marketing or administration cost. So that's other expenses. And then you have depreciation. Okay, the depreciation is the cost that you calculate for using fixed assets. Okay, the fixed asset.
Can you do an example of how you calculate depreciation?
Yeah, so we're gonna talk about the depreciation later, how to get the depreciation. Yeah.
Okay, thank you.
Mm-hmm. And the depreciation, okay. Basically, you have two ways. Okay. One is called straight depreciation. Okay, it's called straight line. Straight line depreciation is that, for example, you have a product, it worth okay, $1,000, and the life is 10 years, right? You can use it for 10 years. So the straight line depreciation you depreciate is going to be $1,000 divided by 10. Okay, so after 10 years, the value of that products is gone. So the depreciation that you do is every year you depreciate $100. Okay, and later on is we have another one. It's depreciation is different. It's called Marcos. Okay, so let's see, we call Marcos depreciation. Okay, so what is Marcos? Marcos is the modified accelerated cost recovery system. Okay, this one is different. Okay, so we can have, they have a table here. So it's, okay, let's see this one. If the product's the life is for a 3 year, so that's how they depreciate. First year, 33%. The second year, 44%. Okay, the third year is 14.81%. So they depreciate more in the most recent several years. And then gradually the depreciation rate reduces. Okay, good. Any questions?
No, sir, I
good so far.
Okay, good. So this is another way. So you can see maybe you can Google something. The second, what is Marcos depreciation? Is a Marcos depreciation that, for example, you buy a new car and you put in a garage, okay, and they depreciate immediately, several thousand, after a couple of days. So they depreciate a lot more in the first several years. So Marcos depreciation or straight line depreciation. And after the you exclude all those expenses and depreciation, okay, those are let's say this all these and you have EBIT. Okay, so EBIT. So what is EBIT?
It's the earned income
Earnings
for
before
taxes.
Yes.
earnings before interest and taxes.
Yeah.
Interest and
So
taxes.
earnings before interest and taxes, right?
Mhm.
This is called EBIT. EBIT is also called operating income or operating profit. Okay, there's operating income or operating profit. So you go back to see the financial statement for Walmart. You can see here.
Right there, I see it, operating income.
Yeah, operating income, right?
Mhm.
Yeah, operating income. So this one you see it does not have EBIT here, but you know that operating income is your EBIT. So it's the same.
Correct.
Okay. And then you exclude your interest expenses. Okay, so interest expenses, that's called pre-tax earnings. Okay, the pre-tax earnings is pre-tax earnings is earnings before tax. Sometimes we call this one is earnings before tax. Okay, pre-tax earnings is earnings before tax. So I call ABT, earnings before tax. And then you exclude your tax, okay, and earnings after tax. So you need to earnings before tax, exclude the tax. Okay, so you see if the tax rate is 40%, okay, the 40%, that's your tax. So how you get this tax? Okay, use a 40%. Okay, this
That's the
number.
pre-tax earning.
Okay,
So multiply 0.40 times $146,600.
yeah, that's equal to exactly this number. Okay, good.
Okay.
Yeah, very good. So that's the difference is they need to you times 40%. Okay, and then you calculate the tax. Okay, this is the tax. This number is going to be is going to be your tax. Okay. Okay, that's how the number come out. The tax of 40%.
Mhm.
And your earnings before tax minus your
Taxes expense.
tax, and that's your net income. Okay, good. So so in the income statement, you know, you need to know several important is that several things. Okay, the first is your gross profit. Gross profit or gross income. So what is your gross profit? Gross profit is sales minus cost of goods sold. Okay, sales minus cost of goods sold. That's your gross profit. And then you have your operating profit. Operating profit, right? Operating profit is your is a gross profit. So you have a gross profit and minus your other expenses. Okay, yeah, other expenses. And also you minus your depreciation. Okay, so that's your operating profit. You can see in this is other expenses depreciation, right? That's your operating profit. Operating profit is also called EBIT. So, and then your EBIT, earnings before tax. Earnings before tax is your EBIT or the operating profit minus your interest expenses. Okay, your interest expenses, that's your earnings before tax. So the earnings before tax, right? And then your earnings before tax, and after minus your tax, okay, that's your net profit or net income. Okay, net profit or net income. They are the same thing. Okay, sometimes we call net profit, sometimes we call net income.
So, Dr. Low, you put EBT equals EBIT equals interest expense or minus.
Oh,
interest
minus.
expense.
Yeah, sorry.
Okay.
Yeah, this is minus.
Okay.
Okay, so we see that income statement mainly you're talking about the profit. So what kind, when people ask you the profit, you need to ask what kind of profit. You mean gross profit, operating profit, or net profit, right? Net profit. Okay, that's what we focus on the income statement. So we talk about next questions, what happens to the sales and net income. Okay, so the question, why they ask you this question? Because when your sales increases, typically your net income will increase. However, they are not on the same path. Okay, are not going to on the same path. So what that means is that your sales increase a lot, but doesn't mean your net income will increase a lot. Sometimes your net income could be negative, even you sell a lot of products. Okay, your sales increase a lot, you might got small net income or negative. Okay, and because you have to exclude all the expenses, different kind of expenses. So when your sales increases, you need to forecast the money, the fund you need. Okay, that's the most important thing. To plan ahead how much money you need to support your sales. Okay, so we're gonna later on we'll talk about the additional fund need for this question. Okay, so any questions?
No, so far.
No.
Okay, good. So because the Zoom is going to run out of time in a couple of minutes, so we stop here, and then around like 5 minutes, we got back again. Is that good?
Yes, we using the same ID.
Yeah, the
Do
same
we?
ID. Yeah.
Okay. Okay.
The same ID. So we just take around like a 5 minutes break. So we come back again.
All right.
Okay.
Okay.
Yeah. Okay.